Hey everybody, it's Boris Schlossberg. Welcome to the new week of Trader Fade. We're going to take a look at all of the events happening for the week of 27th of March to the 1st of April. And this is actually a relatively significant fundamental week. The big key event, the marquee event is going to be the Friday's non-farm payrolls. And the big question in front of us is whether the U.S. economy, despite the very, very strong price pressures, despite the incredible geopolitical hits that we've had over the last couple of weeks, continues to really roll along. That's been, I think, the big surprise from the start of the year, just how strong the job engine of the U.S. economy has been. The market this month is expecting a significant drop-off from last month, 485 against 678, but that's still a very, very significant growth rate. And the actual unemployment rate is forecast to come down to 3.7%. I mean, that is really essentially full employment. And it still remains to be true that I think when you look around at U.S. businesses, there is something like 2-3 job openings for every job there is. It's a very bullish environment despite all the inflationary pressures in the economy, which is kind of, I think, cognitive dissonance to a lot of economists who are screaming recession, 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 when in fact growth continues to be the key point. The really big issue from the U.S. economic point of view is going to be the growth in average hourly earnings, because the situation that's happening on the ground right now is because of the super fast pace of inflation. The nominal rate of earnings is actually declining. So what we're having is basically lots of jobs at a smaller pay rate in real terms than we've had really since the 1950s. Still, despite all that, there's just plenty of jobs to be had, and ultimately, regardless of whether the nominal rate is declining, the amount of new people with new income is very, very bullish for the U.S. economy as far as final demand goes. And I think if we have a strong number, should be relatively positive for equities, definitely positive for the U.S. dollar. So we're going to be looking at all that as far as asset goes. But as far as the other big story, of course, Ukraine, that's an open question. We really are watching everything as well as anybody else in terms of hoping for a diplomatic solution. It feels, with Ukraine turning the tables at this point, and of course everything can change in a heartbeat, but it feels like if Ukraine starts to push Russia back, there's almost going to be just an inexorable pressure on Putin to settle. And of course that will provide a very, very significant relief, both on the geopolitical grounds, but probably on the financial grounds as well. So we have to monitor the story carefully. It changes every day. It's impossible to predict. Politics are never easy to handicap, and this one is especially very difficult. But against that background, if you have sort of like this double whammy of possible peace negotiations and still a very, very strong U.S. Job engine growth, should be relatively positive risk as we get into next week. And that positive risk is definitely being expressed in the equity side. We talked about the fact that, NASDAQ recovered the midpoint last week, and we said, you got to be bullish. This was a big move. Now we're coming up against pretty significant technical resist points at this 15,000 level. Having said this, though, the correction or the bump against this resistance may not necessarily be very, very severe correction, because as I said, if we get this double combination of strong growth and perhaps a ray of sunshine on the geopolitical front, should be very positive stocks. In a very macabre way, you have to understand that once war is over and peace takes hold, there's an enormous amount of capital spent to occur everywhere, and that should be extraordinarily positive for equities globally. We'll have to see. It may be premature to be hoping for any kind of resolution. All we can say is that from a technical point of view, equities look very well bid. It seems to be buy the dip trade right now, much more than any kind of a fade the rally. Though the move to the 15,000 probably, I would be shocked that this 15,000, 15,200 level isn't going to incur pretty serious resistance, as this was former support. Current resistance, you would really have to have uber bullish news to blow through this without any kind of a pause. As I said, though, the pause doesn't necessarily mean a full corrective move. So I still favor kind of buying the dips here in NASDAQ for, at very minimum, at least a run towards the 15,000 if we get any kind of positive news as the week goes by. The Dow also looks quite good. As a matter of fact, you could even make the argument Dow is more bullish than a NASDAQ. This 35,000 is a minor resist point in the Dow, in my opinion. And the true resist point could be as much as 1,000 points higher. Dow has been relative bid to NASDAQ, partly because, remember, Dow is the more industrial part of equities. And higher rates are very negative. NASDAQ, which is built upon high technology companies that essentially love free money and have very high multiples. The lower multiples industrial companies that could really benefit from the rebuild and a kind of an industrial investment climate, both on all sorts of fronts, on the oil front, on the industrial front, on the rebuild front, all of that, even on the defense front, as we build up our defense capabilities against all of this geopolitical risk. That's all really positive Dow relative to NAS. And in fact, if you're trading pairs, it would make more sense to be long Dow, short NASDAQ on a relative strength basis. But on a purely positional basis, Dow seems to be the leader here. And as I said, the 35,000 is a minor resist point, and it really looks like we could go to 36,000 before we find any significant resistance points here on the charts. Now, oil has been a very, very, very interesting asset. We've traded this to the upside. We sold it off the highs. We bought it on the dips, and we said it was going to be kind of a churn, which it pretty much was this week. It's a churn with an upside bias, and I think that's probably the most accurate way of how I would trade this. So this is essentially very much a buy the dip type of a trade. Now, there is some conversation here that if we do get some kind of a negotiated settlement, the first thing that's going to happen is Russia's going to have to dump a massive amount of oil onto the market in order to just simply liquefy its asset, to basically get cash in the bank. It's on the point of starvation. So it's certainly feasible to see if we get any kind of a positive move on the diplomatic front, a big corrective move, perhaps down to the 100. But all of that is going to be corrective. There may be, some people even argue that the corrective move could be so vicious as everybody kind of liquidates really quickly that it could break this support level at 92 and just kind of flush everybody out. Very, very possible. I still think that the tactical proper trade here is buy the dip. Now, you may have to get a little bit more conservative in how you want to buy the dip. So you probably would have to be a scaled down buyer. So a little bit at the 110, a little bit at the 100, a little bit at the 95 if you are trying to position yourself for the second leg up. But it really, really fundamentally feels like oil will remain tight for quite a while, and the trend remains very much to the upside. If we have a rebuild area or rebuild era, that's going to have to create more demand for oil. It's at this point very much a slow, constrained, high demand product, simply because the supply just isn't coming on the market nearly as much as everybody thinks. That having been said, though, Russia dumping on oil on the market certainly can offer a very, very quick move to the downside, and I would be careful about getting too large on these positions. Still, to me, the trade right now, we took the mid-month, retook the mid-month highs. It's positive unless proven otherwise. In fact, if you wanted to trade it tight, I would be a buyer here and stop myself out around 105. At 105, that would clearly signify a corrective phase that's going to take us down to 95 on that move. So the bias to the upside, but a much more muted bias than before. Gold was interesting this week because, to me, gold was actually more bullish than it seemed. And the reason why gold is more bullish than it seemed is because it really found some pretty hardcore support here at this 1900 level and held. And I think you have to respect the fact that the buyers really came in. We had the initial impulse move, big corrective move to the downside. And to me, as long as the trade holds at the 1900, you have to respect the upward move. As a matter of fact, you got to respect the fact that while oil was sort of flat end of the week and equities were up and down until they kind of closed up for end of the week, gold really held bid and traded pretty well to the upside. The last couple of days, this 1950 has been kind of taken out. It's fully reasonable to think that oil could go to 2000 over the next week and a half. There's certainly plenty of reasons. You know, you have higher inflationary pressures, perhaps even more geopolitical risk. But most importantly, it's just simply the price action. The price action is communicating that there are buyers and they're willing to buy the dips, and you have to respect that price action. To me, again, I like gold here as a trade into next week to the long side. The 1900 is the hard stop. If that collapses, clearly that position is wrong. But this end of the week buying in gold was absolutely a very, very bullish sign as far as price action goes. Now, on FX, I think FX has been sort of very interesting. Let's just take a look at my FX list here, and let's go just to the majors for just 1 second. The most interesting story in FX to me, of course, is dollar yen. And this is a clear vertical parabolic move. And you know how much I love vertical parabolic moves because contrary to what everybody is looking at right now and saying, oh, it's super, super bullish, to me, this is one of the greatest bearish setups there is for the short term. I'm not saying that this is a top. I'm saying it's a very strong corrective signal here. Now, we did try to correct a little bit to 121. They bought it back, so it's sort of ending up the week mildly bullish. And there's clearly possibility here to go a little bit higher. As a matter of fact, let's take a look at the weekly chart on dollar yen, because this is how I would trade this over. Sorry, let's go to the monthly. I want to get really, really wide because I want to go a couple of years. Yeah, right here. Here's the monthly. This is how I would trade this into this move. So the big, massive parabolic move is just begging for some corrective price action. But you have to understand that there is a big pocket here, probably from 22 to effectively 26, right? There's a 4-handle pocket here into which dollar yen could push before it finds a pause. So just as we were pretty confident in shorting oil into the 120 zone on a scale-up basis, I think the dollar yen trade is a scale-up short here, 22, 23, 24, 25 with a 26.50 stop. So it's got to, you have to pace yourself, you have to size yourself. But to me, these are interesting corrective moves, probably down to the 120. If it goes to 124, the corrective move probably comes back to 22, 21. But regardless, I like shorting this into strength strictly on the fact that we're so grossly overbought. We're up 10 big handles, 10 big figures from the low. Those type of moves in FX clearly deserve a pause. And that, of course, means everything on the yen side. So you can make the same argument on Aussie yen, where you can be a scale-up trader, and perhaps you want to express that against the crosses, which is maybe less of a vertical move than just a pure dollar trade. So an Aussie yen trade here at the 92.50 against the 96s would be really interesting. Euro yen, certainly. Here's the Euro yen trade. I really like that short. That looks super bullish on the monthlies, super bullish. So, if you're looking at this chart, you're like, oh, I definitely want to be long. And yeah, long, if you have a 5-figure stop, you probably do want to be long. But if you want to be looking for the next couple of 100 points, I think they're to the downside and to the upside. So I like very much the scale up short here at the 34s, 35, 36s, probably with a stop at 37.50 at the spike high stop on the euro yen move. As far as that goes, and at the same time, as we see some possible corrective moves in the yen crosses, I absolutely see some corrective moves in the Aussie and the Kiwi, sort of like if this is the monthly chart, but if you go back to the daily chart, to me, the Aussie very much topping out of the 75 handle, and I definitely like the 75, 75.50, 76 short with a 76.50 stop. I don't think we're going to see much further movement to the upside here. It's not that I'm going to make a big fundamental argument. It's just simply that I think the whole commodity fever is going to start to calm down a little bit, and that's going to start to have some corrective impact on the Aussie and the Kiwi, which have just had been parabolic moves to the upside. So that's pretty much how the week shapes up. I think we have an interesting week ahead. We got some fundamental news end of the week. We may have some kind of a geopolitical breakthrough, and we are at these incredibly overbought levels in the Aussie, in the yen crosses that present us with some interesting counter trend trades. Wish you guys the best of luck, the best of trading. Boris Schlossberg, over and out.